Money Emerging Markets editor John Defterios joins me now with more details from Abu Dhabi. And John, I'm reading this and thinking to myself, OPEC sticking to production cuts, non-OPEC sticking to production cuts. That's an awfully big ask. These are groups that are not known in the past for their discipline.
And look at the market response so far. Despite that, Maggie, $58 in North Sea Brent, and as you suggested, an 18-month high. And OPEC may have a very poor track record of delivering cuts in oil production, but traders seem to have erased that from their memory bank, if you will. All signals actually point to a newfound discipline, and the reason why we hit this $58 a barrel on the first day of trading in 2017. For example, to give you a sense of the mood within OPEC, OPEC Secretary General Mohammed Barkindo sent me a text over the holiday saying that the Compliance Committee will meet here in Abu Dhabi on January 13th, and adding, this is a quote from him, a premium is on compliance. So let's take a look and remember back to that November agreement, actually what's on the table. OPEC plans to cut 1.2 million barrels, and non-OPEC just under 600,000. And as you noted, Maggie, in both instances, Saudi Arabia and Russia represent about half those cuts. So if the two biggest producers are in, they can, shall we say, persuade the others to comply. And even locally, again, for some context, here in Abu Dhabi, the state oil company notified customers it will be trimming back deliveries this month to hit their targets. And then today, Kuwait and Oman also confirmed they will cut production as well. Now, there is one wild card you and I spoke about in the past, and that is Libya. It is exempt from the deal like Nigeria due to their conflicts over the last 3 years. It boosted production by nearly 100,000 barrels in the last month and noted it wants to add another 200,000 barrels a day by March if the security situation remains stable. Now, this is all the more reasons, if you will, for the other members of OPEC and even non-OPEC to comply to the agreement of late November and then the non-OPEC players in early December.
John, is this newfound discipline stemming from necessity? I mean, so many of these countries and their home economies were so hard hit, even those that in the past seemed like they were, not vulnerable at all. We've seen massive changes, haven't we?
Yeah, and in fact, we saw Saudi Arabia produce the worst economic growth for the quarter in 3 years yesterday. So right to your point, exactly the reason why they want to adhere to the cuts. OPEC and non-OPEC producers are riding the big mo right now. We're momentum in the market. We're at peak demand, which I think is an important point in the winter months in North America. So these cuts are hitting in a very tight market, and that is their strategy, to ride that momentum. And while at the last OPEC meeting, I spoke to 4 ministers, and they all said the same thing, Maggie. There's no reason not to comply. Saudi Arabia, Iran, and Iraq, and UAE all said the same thing. $60 is much better than $40, even if it means giving up some market share. And at this level, we know, and we've talked about it in the past, U.S. shale production will come back. So the real test will be in the spring when demand tapers off and whether this group of producers will be willing to do more if the price corrects, because the shale production will come on board. That'll put downward pressure when demand drops. Will they come back in June and roll over the agreement or even go for deeper cuts? It's a huge question mark, but far too premature as they enjoy this rally to $58 on North Sea Brent.
Unity for now. We shall see. John, thanks so much. John Defterios for us.